Welcome back to another finance video. This one is not going to be about cryptocurrency specifically, because I know a lot of the videos I've done lately have been regarding blockchain and cryptocurrency. And although the frenzy that is cryptocurrency is what is inspiring this video, it's not dedicated to cryptocurrency. It's actually designed to help you broaden your scope of investing, so to speak, because I feel like so many investors right now in the cryptocurrency market specifically are getting tunnel vision. They're only investing in crypto because the returns are astronomical. They're really excited about the market, which I totally understand and can sympathize and empathize with. But at the same time, a lot of them don't necessarily have a financial background, or the ones that do can easily be getting distracted and losing sight of the fact that getting tunnel vision on any particular one investment is extremely risky, which is why this video is dedicated to the concepts of diversification and rebalancing and why it might save your behind when the cryptocurrency market just evaporates for a while. Because honestly, you could call it a bubble, you could call it a castle in the air. There's a lot of different terms for what's happening right now with how much money is being grown exponentially and the returns that are occurring exponentially in the cryptocurrency market. But regardless of what you want to call it or how you want to view it, it's something that is inherently very risky. And it reminds me a lot of what happened with the housing crisis and the tech bubble. I especially want to relate the cryptocurrency bubble to the tech bubble because I think they're very, very similar in their nature. In terms of historically speaking, I think they're the most similar comparison that you're going to have, because you have, with the tech bubble, you had technology, this new revolution of the internet that was going and has fundamentally changed the way our entire world works and our entire culture works. It has made a lasting impact, but all the money that was flowing into it in the beginning was not sustainable. I mean, obviously things balanced out after a while, and part of that included a huge crash in about the year 2000. And I think a similar thing is happening with blockchain. We have blockchain technology now, which is, I believe, going to fundamentally and long-term change the way our entire scope of economics works worldwide. However, all of the extra cash and capital being funneled into this market right now, into this bubble right now, is not going to be sustainable and is not going to reflect the long-term investment potential and wise investments that blockchain is going to provide. So that being said, while we are in this growing bubble, this frenzy, I think it's important to point out classic concepts of finance and economics that, again, are potentially going to save you. The first of which, let's jump into it now, is diversification. So diversification is one of these golden rules that they teach all of us finance majors right out the gates. And the reason for that is because in finance, it's all about risk and reward. And one of the best ways that you can minimize your risk when you're investing is to diversify, which means take your investments, take your capital, take your money, and spread it out over multiple different types of investment vehicles. For example, classic examples are stocks, bonds, mutual funds. Nowadays, we have ETFs, which an indexed ETF provides you automatic diversification, usually at a relatively low cost in terms of the expense ratios. I personally am a huge fan when it comes to traditional stock investing. I am a huge fan of index funds, like funds that are broad market index funds indexed to the S&P 500, or pick whatever index you want, that are, again, relatively low expenses. Therefore your returns can be a lot higher. They're not actively managed, so you're not paying as much in terms of management costs and fees associated with the funds, but you're getting returns similar to holding the S&P 500, which is a very well diversified portfolio of stocks. But again, stocks is just one asset class. When I'm talking diversification, I'm talking let's really branch out here and get creative, because that's the other thing. The more inversely correlated your investment decisions are, your diversification is, the more likely you're going to be able to lower your risk. For example, traditionally, stocks and bonds are usually inversely correlated, historically, I should say. Nowadays, with the way funds are structured, they're actually kind of starting to become more positively correlated. But historically speaking, traditional examples, stocks and bonds are inversely correlated, so it's good to own stocks and own bonds. That way, when stocks are doing well and rallying, bonds typically aren't doing as well, so it might be a good opportunity to rebalance, which is the other concept I'll be talking about, where you take money and returns out of the like high rallying stocks and you put them into the lower, cheaper bonds, so you can be buying at a discount, buying low and selling high. But again, I want to move beyond stocks and bonds because right now we're in crypto markets, which are rallying like crazy and making returns like crazy. And a lot of crypto investors are reinvesting these returns into other cryptocurrencies. And what I'm seeing a lot of happen in the market right now is they're taking relatively solid cryptocurrencies like Bitcoin and Ethereum, and I think Litecoin's a pretty good one. I think there's some really solid, really high integrity cryptocurrencies out there. They're making really high returns on those, and then they're cashing a lot of those out to then invest in what a lot of people are calling quote unquote like shit coins, essentially, which is the ICOs and the currencies that are being issued that are of much poorer quality. And those are the ones that are gonna burn you in the end when everything evaporates, when the bubble really pops. Like those are the equivalent in the housing crisis of like the really crummy mortgages that were issued, like the absolute like lowest quality, lowest rated mortgages that were issued. Like those are the equivalent of some of the really crappy coins that are emerging in the markets that people are investing in because they made all this money in like Bitcoin or some of the bigger ones, and now they want to try and relive a lot of those like huge returns in something that's much lower quality. That's risky. And then rebalancing, let's define rebalancing because that is a very important part of this equation as well. And rebalancing is another technique that they teach to us finance people that helps to decrease your risk and can also help maximize your returns, because it's all about risk and reward, risk and returns, balancing it out based on your tolerance levels and goals. And so rebalancing is a great way to incorporate that into maximizing your returns, minimizing your risk, staying focused on the goals you have for your money and the payout you have for your money. Something else about rebalancing is that when prices, and the way it's done, like the way rebalancing happens, is it gives you indications of when to buy or sell high and buy low for the most part. Because when prices are hitting all-time high levels in one asset, for instance, cryptocurrency, like you have these all-time highs that are being hit all the time, and I have a feeling things are going to get even higher. You cash out some of those returns periodically as you hit certain targets, certain percentage rate of return targets. You cash out certain percentages, and then you put it into investments that are well diversified, non-correlated, for instance, like precious metals. And that brings me to my example, like a really good real life example to relate to, is the fact that in Ethereum, I made like 2,000% returns over the course of 6 months, which with my finance background and all the investing I've done, I can honestly say that is ridiculous. That is incredibly high. That is the type of return you would expect in Vegas at a blackjack table, not the types of returns you expect in something that's going to be a solid and reliable long-term investment vehicle at all. Therefore, I'm going to treat it more like a blackjack table, a short-term, like really spike high kind of return situation, less like a long-term reliable investment vehicle. Therefore, when I saw that my returns were ballpark, that percentage, I was like, okay, time to cash out a big chunk of my Ethereum investment. Not all of it. I definitely still have some faith in Ethereum. I don't want to completely go hot or cold, black or white with it, or black or red, if we're going to stick with the gambling reference. But anyways, I cashed out a solid percent of it and reinvested it into precious metals in the form of this necklace right here. And I honestly hit it so well in terms of a buy low and a sell high. I sold really, really high on Ethereum, and I bought really, really low on this 14 karat gold necklace because my local Sears was going out of business, and I got this thing for like 70% off. It originally retailed for like $1,800, and I got it out the door with California retail taxes and everything for under $600, which is awesome. And it's something I still have the tag on, to be honest with you. It is not my style whatsoever. It just so happened to be the last piece of 14 karat that they had in stock. Everything else was 10. And if you're going to be using precious metals and like real assets as an investment, I highly recommend getting, in terms of gold, I recommend getting 14 karat instead of 10, because that's what they're going to trade you out for. They're going to trade you, cite it at like a 14 karat price, not a 10 karat price. So again, this was the last piece they had. It's definitely not a fashion statement. It's going to stay locked up until gold goes through the roof, and then I'm going to sell this out and then reinvest it into something else, rebalance into something else, diversify into something else. Let's see. And again, I think this is a really good example because these are two really, really different investment vehicles. Two very different asset classes. One is digital, cryptocurrency, and the other one's physical, which, I mean, that's pretty rare. That's like, trying to go from like stocks to real estate. You have something like really solid, long-term, real, tangible investment, and then you have something that's like a stock, which can be a lot more fickle in nature. Let's see. The other one, or one of them, being cryptocurrency, has been around for a very short amount of time in terms of its proven investment track record and potential. Gold has been around an extremely long amount of time in terms of its proven track record and investment potentials. What else? And each of them are subject to very, very different market conditions in terms of what is going to determine supply, demand, and therefore price of Ethereum and cryptocurrency versus what's going to determine the supply, demand, and price of the gold. Another fun part of this, to me, this is the fun part, is choosing your investment. And I think when you're coming up with your list, your repertoire of like what your potential investment vehicles are going to be, like what's important to you, what's of value to you, it's important to pick something that you're passionate about and interested in, because the more passionate and interested you are in the investments, the more likely you're going to be to make well-informed decisions. Because if you're really into tech stocks specifically, you're going to be more likely to want to read up on the news and keep up with what's going on in tech stocks, therefore be able to make a more well-informed decision, and have a better inventory of when it's actually a good time to buy and a good time to sell. So again, pick things that you're interested in, you're passionate about, but not too passionate. Like, there is an extreme end of this where some people are so passionate about a certain investment vehicle asset class that they get that tunnel vision I was talking about in the beginning, and they focus only on it, and they get a lot more emotional about the investments, and therefore a lot more hot and cold and extreme, and those are the ones that tend to get burned in the end. So pick something that pick things, multiple things, diversified amounts of investment vehicles that you're passionate about, but not too passionate about to where your judgment is clouded. And another way to make sure your judgment over time doesn't get too clouded and you're able to make sound investment decisions is to set goals for yourself. I mean goals in terms of like percentage returns. For instance, if you think 20% return on like a broad market index fund is really, really good for a broad market stock index fund, then maybe you should make 20% one of your sell targets. So if you hit 20% or higher, or you're approaching that amount, then have that as a goal set for yourself to be selling. Yeah, maybe it goes up to 24%, but I mean, chances are, given that asset class and how it traditionally behaves, for a broad market index fund, you're probably not going to get 24%. You should be pretty dang happy with 20%. And timing makes a big difference in finance too. When you cash out that index fund at your 20% really good return level, even if it does go up a little higher, at least you freed up that capital to invest in something that's even relatively going to have more payout and more potential. Maybe it's in the form of real estate or whatever it could be. But yeah, have some goals for yourself. Again, that helps you stay focused as well and not make too many emotional and very potentially detrimental decisions. Be okay with straying from the plan a little bit. For instance, like I didn't have a plan to go buying physical gold within the last year or so. But given the fact that Sears was going out of business, I was getting this massive sale. I was up on the news and the timing of things, like it worked out well to take some of that capital and do it now. So have some wiggle room for yourself, but set goals. Okay, so moving on. This is the most fun part. This again is coming up with your list of potential investments that could be fun and interesting for you to keep up on and invest in. This is just an example list. But some of the things I put are stocks. And within stocks, you have all kinds of different stocks and industries and companies and countries. And I mean, I definitely recommend broad market index fund type stock investing. But if you're going to be speculating anyways, and that's a fun thing for you, pick something you're passionate about. Like maybe it's the tech industry. Maybe it's emerging market company or emerging market businesses in Singapore. So again, you have stocks and a lot that exists within the stock market. You have bonds and a lot that exists within the bond market. You could go corporate bond, you could go subprime bonds if you really want to. You could go government bonds, municipal bonds. There's a lot of options within bonds. Maybe those are interesting to you. Go with it. Cash or fiat currency. I mean, let's face it, cash is always a good thing to have on hand because it's very liquid. Cash, and now things like Bitcoin and certain types of cryptocurrencies allow you to very easily and more liquidly move between, cash allows you to readily move between asset classes and different types of markets relatively efficiently and in a liquid way, whereas crypto allows you to move very quickly within crypto, not necessarily within different asset classes, because I couldn't go into Sears and buy this with Bitcoin. It's just not the way things are structured in our culture yet. You have ETFs. I personally am a huge fan of ETFs, like broad market index funds ETFs, like SPY has a special place in my investment heart. It has for many years, for very good reason. Thanks to one of my best investments in my entire life, this book right here, A Random Walk Down Wall Street, this is what got me into broad market index fund investing and diversification and rebalancing and to some degree dollar cost averaging. I follow the markets too close to rely on dollar cost averaging because I check them often. But bottom line is I was a finance major, I was in the honors program, I took all kinds of classes. I have CFA books here that I use as a reference and that I've studied before. I never sat for the exams, but still I'm very well educated when it comes to traditional finance, but on a practical, how I actually choose to spend my money level, nothing beats this book. The returns you get on this investment, in my opinion, are far greater than the returns you could get reading almost anything else related to finance or studying it. It was actually in one of my honors finance classes that this book was required reading, and total game changer. It also does an amazing job, especially for you crypto investors. This book also does an amazing job of going over different bubbles that have happened over time, or it refers to it also as castles in the air. And I think it would help all of you guys that are into crypto, especially get more familiar with the potentials, upside, and then eventually huge downside that could happen if you're not careful. I am in no way endorsed by this book. It really just has become a huge staple of my investment world, and I love it, and I recommend it. Thank you, Burton Malkyle. Anyways, moving on. Okay, so that was my spiel on ETFs, which again, I'm all about them. Mutual funds, I think broad market ETFs are a better investment than mutual funds, but this isn't all about my opinion. This is all about potential investments you can have. So let's just move into it. Derivatives, including futures and options. You could invest in startup companies in the form of being a venture capitalist. You could invest in real estate in the forms of commercial real estate or residential real estate. Maybe it's something as simple as paying off your mom's house. Like, that has a lot of value and returns on a very practical level. And probably makes you feel good and your mom feel good at the end of the day, or maybe like your grandma or whoever. Or maybe you could get investment property that you rent out in the town that your kid's going to college in. Like, there's a lot of potentials where you can really synergize like certain meaningful people and life events and experiences into making returns on certain types of investments. So keep a lookout for those synergies that are out there. I think they're really important. You could also use your money to diversify and invest in cryptocurrencies or ICOs. But again, be careful because it's a big bubble that's happening. That's going to pop eventually. But it's exciting for the time being. So just do your research. Do what feels comfortable. You can invest in crude oil if you want to. You can invest in precious metals if you want to. You can invest in art. Maybe you're a really big art buff and you have a good eye for what artists are going to be successful over time. Go ahead and do that. Baseball cards, that could be something you do with one of your kids or one of your grandkids or something. That's like a meaningful experience and potentially has added value if you ever decide to sell them and you made a good decision. Education, again, now I'm starting to get into the more like meaningful types of investments. I mean, I went from the very traditional, like you're just making money, kind of looking out for that kind of thing, to like if you're going to be cashing out some serious returns in whatever market it is, like I think there's meaningful investments to keep in mind too. And that's why I put down things like education. Like going back to school can be a very valuable investment, especially if your earnings potentials are going to be greater after you graduate. And I think just a well-educated society is a good investment in our entire culture, to be honest. Nonprofits, a lot of times the utility that you have for that extra like couple $1,000s is a lot less than the utility that someone else across the world might have for that extra couple $1,000s. Like maybe that couple $1,000s could buy you a vacation, but it could buy them food for the next couple years. Like you never know. So look into like nonprofits, philanthropic investments in terms of like diversifying not just your financial portfolio but your life at this point. Even a vacation with your family, like this is the one where I get most meaningful. Like maybe you do want to spend that extra money on a vacation with people that you love, and at the end of the day that valuable time with people you love is priceless. Like that type of stuff, those memories, I think maintain their value better than almost anything else I've already listed. Here's a big thing they taught us in finance too. No woulda, coulda, shouldas. Woulda, coulda, shouldas. I should say that slower, otherwise you might think it's all one word. No woulda, coulda, shouldas is a lesson in finance that they really wanted us to learn, especially as students, because something that happens all the time is that you get caught up in the fact that you sold that ETF at a 20% return and it went up to 24% return and you're kicking yourself for it. And believe me, there have been times where I have made much larger discrepancies than that on buys and sells and have kicked myself for it. But at the end of the day, you can't change that decision that already happened. You can't go back in time. Talk to Elon Musk about making a time machine and then maybe we could switch things up a little bit. But for now, you can't go back and change your mind. And you definitely, nobody has a super crystal clear ball for what's going to happen in the future. So don't kick yourself for the past. Don't assume anybody, any opinion out there, including all the news, all the media, even Warren Buffett, not one single investor in the history of anything has a perfectly clear crystal ball on future prices. So don't get too caught up in pressure for yourself on that. Best thing you can do is like knowledge and experience and goal setting over time help make that crystal ball clearer, but don't have too high expectations, bottom line. Just stay informed and do your best. So no woulda, coulda, shouldas, just stay informed, do your best, try to stay focused on the goals you set for yourself financially, and hopefully that helps you sleep at night and make returns that are a nice fit for you and maybe even above and beyond what you intended. And have fun. To me, investing in finance at the end of the day is a very fun and exciting thing. I've always just gotten so excited about even from like a young age, just like rolling coins with my grandpa. And I don't know, like there's a lot of, or like for some people, again, art is really interesting, or jewelry is really interesting, and fashion is really interesting. Like, no matter what industry or focus you're into, chances are there's a way to make decent investments within it. But again, try and diversify that out. As a disclaimer, just to wrap this up, and I put, although I have dedicated a lot of knowledge and experience to finance, my perspectives are not foolproof. So do more research, take responsibility for your decisions, and know that all investments that you do decide to make at the end of the day are done so at your own risk. And beyond that, if you want to connect with me further, then feel free to leave constructive comments or questions. I also started a new Twitter account called @Kendinomics, spelled KENDINOMICS. That would be kind of cool spelling. But anyways, it's Kendinomics, kind of like economics, but with my nickname in it. And then on STEEMIT, I'm still there as Kendi, KENDI. I will put all of this in the description box below, and the Google Doc that I'm reading from right now that I made my notes on, it might be a good reference for you. I will try and leave a link to that in case you want to use that as a quick reference instead of watching this almost 30-minute video over again. I hope this was informative and helpful, especially for all my crypto homies that are getting a little bit too caught up in that particular market. Spread out your investments, enjoy the returns you already got, and yeah, rebalance in good ways. That said, peace out. Bye.